growth versus value. Is growth always better? Does growth always outperform value? Also, I'm going to show you how we can learn a lot from this one brief period of time. Recently, the Nasdaq and tech ETFs have been hitting record highs. Will this continue forever? If we look at all the tech ETFs, such as the Vanguard Information Technology ETF, VGT, the performance year to date is 36%. If we look at QQQ, it's roughly 30%. XLK, which is a tech ETF, 28%. And last of all, if we look at the S&P 500, it's 28%. Now, if we go to the 1 year, it's roughly about the same. If we go to the 5 year, we really see how well the tech does. In the 5 year period, XLK 174%, VGT 174, 155 for QQQ, and the S&P 500 is at 92%, which is much lower. And if we add the S&P 500 Value ETF, which is the blue one here, SPYV, it's at 59%, so even less of a return. So now what happens if we go back even further to 10 years? Let's go back to 2014. The disparity between tech and non-tech ETFs is even greater now. If we look at the top performer, VGT, 524% versus 120% for the S&P 500 Value and 202% for the S&P 500. So I think this is where most people stop and they just say, okay, let's put more money towards tech. And that's actually what I've been doing. I've been kind of making that same mistake. But this doesn't always work. We have to go back just a little bit further. So we're at basically 10 years now. Let's go back 25 years total. So let's go back to the dot-com bubble. If we go back to the dot-com bubble in 2000, I'm going to turn off some of these because some of these like VGT weren't around back in 2000. So I'm going to disable these now. Now, when we go back further, we still see that XLK, which was available in 2000, did 595% versus 363% for the S&P 500, and the S&P 500 Value, 228%. But this can be much worse. Okay, here's the issue. When we look at this little blip here, this is the Nasdaq Composite Index, which is available this whole time period. We're back all the way to 1994. This little chart here that doesn't look that significant, that looks like something you could trip over, this little blip in the chart here is actually greater than this here. Thanks to compounding, this chart here looks much greater, but this is actually a far greater return. If we go back from the start here, from 95, a 6-year period from 1995 to 2000, the dot-com bubble, we have roughly a 562% return here, just in that short period of time. Roughly 6 years, 562% return. Within a slightly more than a 1-year period, the whole Nasdaq Composite Index, which is thousands of stocks, returned over 120% in just 1 year, 3 months. That hasn't happened anywhere since then. So we've got basically a 6-year period. We've got basically a 6-year period to the bubble, and then another year before it really sort of collapsed. And then it's just sort of flatlined for a long period of time. The issue is if you were unfortunate enough to buy during the peak of the dot-com bubble, which was roughly February of 2000, right here at the peak, if you watched your neighbors, friends, and relatives buy fancy cars and you said, okay, I've had enough of this, I've got to get in, and you put a huge lump sum at the peak and just held on to it, if we look at the dotted line here, you would have to hold it all the way from February of 2000 all the way to 2015 before you would even break even on your investment. Well, let's add dividends just to make it a little easier. Roughly 14, 15 years you would have to wait before you even broke even. And if we look at the S&P 500, which is the yellow line, it did a little bit better because it didn't have as much tech. The S&P 500 did a little bit better here in yellow because it doesn't have as much tech as the Nasdaq Composite Index. But if you bought during the peak, which is around the same time, the break-even point's a little bit better. It's actually, the break-even point is roughly 2007. So if you bought during the peak, you'd have to wait 7 years, you'd break even, then you could start making money. However, okay, so now that we have the start date as the peak of the bubble, you can see here the dotted line, this is 0. You can see here where the line intersects right here roughly 15 years. So the break even 15 years in the red for the Nasdaq, and we see that for the S&P 500 7 years. Now another option we could have made back then is we could have invested over time. So we could have done dollar cost averaging over a period of weeks or years so that all the money wasn't invested at just one time. And then we'd see that the break-even point would be much better. Instead of having to wait 15 years, we'd have some stock that we bought at a lower price, like let's say down here, when the stock price at the peak, it went down almost 80% here. We look here, 73%. So if we would have kept buying throughout the weeks after the person who invested at this point would have done dollar cost averaging and bought some near the bottom, which is around a 70% decline in value from the peak, then this would have had a higher return. The break-even point would come much sooner and there'd be better returns. But there was also another option. Instead of buying the overpriced Nasdaq composite index at its peak, which is vastly overpriced, we could buy some other ETFs that were available at the time, which were small cap stocks, value ETFs, the Russell 2000 ETF. Now when we look at, we've got the S&P 500 here at the bottom in yellow, and then the Nasdaq composite below. This is the returns over time since 2000. Now we see that the break-even point, basically within just a couple of years, the break-even point was maybe a couple of years after buying. And we can see the dotted horizontal line here. Everything above that is profit. So if you would have bought something like the iShares Core S&P 500 Small Cap ETF, IGR, this one right now only has roughly 11% in tech. So it had probably much less in tech back then also. Or we could have bought the iShares Russell 2000 ETF, IWM, which also has a lot of small cap stocks, which are lower priced and have less tech. So if we look at the tech percentages, it's roughly 13% tech. And there's 18% financials, industrials, healthcare, etc. There's also the iShares Core S&P 500 Value ETF. This has US value stocks that are thought to be undervalued. If we look at this one, it has roughly only 7.8% tech, 24% financials, 15% healthcare. Now, if we added these here, you can see these here, they did much better. So if we just bought during that same peak period, but instead of buying tech, we bought something other than tech, we would have a 962% return for this one, IJR, IJT 800. All of these would have been better. Even the S&P 500, 585%. The Nasdaq Composite Index was still only a 348% return. So it was one of the worst performers, even performing worse. Even though the performance during this period has been very good, it's still so far behind because of that major loss from buying it at the worst time when it was very overpriced. It just couldn't keep up with it. So all of these performers, which haven't done really that well, beat the Nasdaq Composite Index. And here's another one. This is the S&P 500 Value. It beat it also. So all of these were basically break even much sooner, and they were making money almost the whole time. Here's another one we can add. We could also add the Utility Select Sector Fund, which this one started in 1998. Right here, you can see 1998. And there's only 31 holdings at this time. But it's a lower price earnings ratio. It's not high price tech. I'm sure back in 1999, the price earnings ratio is still much less than the tech ETFs. Okay, now we've added XLU. Okay, you can see right here, the top purple one, XLU. Even this one did 630%, and this is with dividends reinvested. Even this utility ETF with only 30 stocks beat the Nasdaq Composite Index. So overpaying at the worst possible time, at the highest possible valuation, didn't work out very well in this case. But this is not the only way. If we just tweak this a little bit, we can see that this goes from 348% probably way up here. Now let's add QQQ. Now we can see here at the bottom, the green, QQQ started March of 1999. So we can add that one now. And it's a little bit better performance recently than the Nasdaq Composite, but you can still see it's still behind all of these. However, if we would have changed this, instead of buying in February of 2000, which was the peak of the bubble, if we just modified this a little bit and maybe bought a little bit earlier in the process, let's say 1999, a year earlier, just 1 year earlier, if we would have bought just 1 year earlier, look at the performance now. We look at, it was 349%. Look at the Nasdaq composite now, 749%. And look at QQQ, 1100% now. So just avoiding overpaying for it at this peak, the performance is vastly better. And we can do the same. Instead of buying right here at the peak, we buy a little sooner, or we could buy a little bit after. So when the price earnings ratio was probably 50, 60, instead of paying that, if we just waited a while for it to go down, we bought here, let's say March of 01. We change this to March of 01, 2001, let's just say February. Now we see the same thing, basically 1,000% for QQQ, 713% for the Nasdaq Composite Index. And some of these value picks that we picked are starting to fall behind now, so the performance. But the break-even point is actually much sooner. So rather than have to wait 15 years to break even on the Nasdaq Composite Index or QQQ, the break-even point comes much sooner. So we look here, it looks like maybe for the red one here, looks like basically close to the S&P 500. So by 2005 would be, I guess, close to the break-even versus 2015, which is a huge difference. So I think the lesson here is not to overpay. By buying at a lower price, avoiding the high valuations, the high price earnings ratio, our performance is much better now. And that leads me to what's happening now. If we look currently, as the tech indexes hit record highs, and we look at a tech-heavy index such as the Technology Select Sector SPDR Fund XLK, we see that the price-to-book ratio, that's the price to basically assets, 9.6, which is very high. We look at the price-earnings ratio. This is basically this is actually not the current one. This is a future estimates of the price-earnings ratio. It's showing here 30.75. However, if we look at the index that it's made up of, the price to cash flow 28 times, which is very high, and the price earnings ratio, the current price earnings ratio 41, that's very high. And that's all, I guess an average of all the stocks in the index. Okay, here's another tech ETF, the Vanguard Information Technology ETF. This is like 99% tech. If we look at the price earnings ratio on this one, 39. So the price earnings ratio on VGT is 39 right now. The price to book ratio, the higher it is, the worse, the more expensive it is. 8.2, which is very high. If we look at the historic S&P 500 price earnings ratio, this is actually going to be lower than the Nasdaq Composite, but the S&P 500, the information is more widely available, so that's what we're going to use. If we look at the 1930 stock market crash, it was roughly 26, which you can see is very high. The higher it is, the more expensive things are. We go through the 70s, it's roughly 20, 15, 20. We get up to .com, the .com bubble, 46. During the financial crisis, of course, the numbers don't really mean much because there's lots of layoffs, but we look presently, we're at 31, which is very high. It's higher than it was, all these periods in the past, like it's almost as high as 2001. I mean, it still has a ways to go. Now, this is actually 46 for the S&P 500. You can imagine that the Nasdaq would be even higher than that. If we look at some other metrics here, the S&P 500 dividend yield, we go back to 1930. This was basically the depression. The yield went up after the market tanked, but you can see how low it was before the market crash, 3.52, which is kind of a low for that period. And we look currently, if you look at 2000, you can see how low it went. This is basically the dividend yield, 1.17% in 2000. We look at it now, you can see it's 1.2%. So it's very, very little return, which means it's a high price. And if we look at another one, this is basically the inverse of the price earnings ratio. It's basically the earnings divided by the price. I think that's how it is. It's basically the earnings divided by the price. And the lower percentage, the more expensive things are. So if we look now, it's 3.21%. If we look back in 2000, it was even lower at 2.17. But you can see how low it is. You look historically in the 90s. We look historically in the 90s and 80s, and we go back, You can see we're in the 5 point something percent, and now we're at 3.21. So very high price. And by the way, these numbers are low because if we're looking at the tech indexes like VGT, if we're looking at tech ETFs like VGT, QQQ, XLK, these numbers are going to be even worse. There's also price to book ratio among S&P 500 companies. You can see it's basically an all-time high now. And it was this high back in, it was 5.06 back in 2000. It's even higher now, which is even worse. There's also a Shiller price earnings ratio, which is a kind of a tweaked measurement. It uses cyclically adjusted price earnings ratio. The minimum was 4.76 back in 1920. The max was in December of 99 at 44. The median was 16, and we're at 38 right now. We can see back in 2000 it was at 43. So very high. And if we go back to 1930, you can see where these peaks are, basically where it sort of crashed after that. 31, 40, 43, 38. We also have price to sales ratio. We can see that's an all-time high, 3.18, even higher than back in 2002. Now these small cap ETFs and value ETFs that I selected that seemed like they did pretty well during the period when we overpaid. If we actually look at performance on these, is normally not very good, but the penalty for overpaying for the Nasdaq composite index is basically made these investments much more attractive. If we look at the current valuations on something like the small cap ETF, the price earnings ratio is only 18.56, so much lower. And we see that there's much less invested in tech. So a lot of these companies like financials are typically much cheaper companies or industrials. They're not as overpriced as a tech. Now, even the Russell 2000 ETF, which sometimes the price earnings ratio can go up drastically on something like this, even this one did pretty well compared to the overpriced Nasdaq composite investment. And if we look currently on this one, the price earnings ratio is only 17, which isn't too bad. The price to book ratio is only 2.15. I think it was 9 for XLK, which is much higher. So this is definitely much cheaper. Now, if we compare the performance of the dot-com bubble and we try to find a 550% return, we have to go back around 8 or 9 years with a far more aggressive ETF like XLK or VGT in order to get the same returns that the dot-com bubble got with the Nasdaq composite index, this right here, IXIC. And this is still not 550%. This is at 9 years, roughly. This goes back to 2015 to 2024. We're still not there yet. We'd have to go back to 2013. And then these are higher than 550, but this is still not at 550. We'd probably have to go back to 2012. So if we switch this to 2012, okay, now we're roughly there. So from 2012, so we've got roughly 12 years to equal the performance of 6 years back during the dot-com bubble when this returned about 550% in 6 years. So this shows just how crazy the dot-com bubble really was. And looking at that little chart, the little blip in the chart, it doesn't look like much, but it was a really big deal. Thanks for watching. If you like this video, please press that thumbs up icon. And also feel free to comment and subscribe if you haven't already. Also feel free to check out my Raisin referral offer. Select any Raisin product. Within 30 days, you could sign up with any amount. Within 30 days, deposit at least $5,000. If you deposit at least $5,000 within 30 days and you keep the money there for 90 plus days, you'll get $50. And if you deposit even more money, the bonuses go up even more. Simply select any Raisin product, click Save Now, fill in your info, and enter my referral code in the field. That's all you have to do, and you get some of the highest yields and the bonus on top of that. So pretty good deal. So check for that link below.